A couple weeks ago, I posted a video about debt reduction strategies. And when I was thinking about creating that video, one of the things that was coming up is that I had recently talked to a client about their EIDL loan, and we had been adjusting their balances on their balance sheet to the actual amount of what is due on their EIDL loan. And they were shocked to see that the amount due was more than the original loaned amount. And that was a lot more. And when they looked at and they were like, wait a second, I've been paying on this loan for almost a year. Why do I still owe more than the original loan amount? And I thought today I would show you guys how that happens, because there's a couple things about the EIDL loan that made it very attractive if you got it during COVID, the economic injury disaster loan. If you got it during COVID, it was, if you have been watching the channel for a while, we did some videos on it. But the things about that loan in particular, it was good in a lot of ways, but I think it's misunderstood. And really looking at the math of how this actually plays out and what it looks like for you as a business owner, it's kind of shocking, especially when you think about the interest and how it can accrue. So I want to talk through that today. I'm going to show you an example using my EIDL calculator. I'll put a link to that calculator in the description box below. It's a free calculator. You can go and grab it. And it's, a simplified interest version, but it's going to get you pretty close to what the actual interest would be on your business. The EIDL loan was a daily compounding, and I have this as a monthly compounding, so it changes the numbers slightly, but I just don't want to I don't want to overcomplicate it too much for you guys. If you need this calculator, you can go and grab it. Before we get into that, I just want to say welcome back to my channel. I am really happy to have you here. This channel is all about helping you understand your business finances better and hopefully leading you to more financial success. So if that sounds like something that you are into, as a small business owner, you're very welcome here. I'd love to have you as a subscriber. A couple things to remember about the EIDL loan, and this is for the people who have it and you still, let's say you got an EIDL loan during COVID and now you're thinking about making a strategy to pay it off, or you're just thinking about, hey, I should maybe know what's going on with this loan. Or maybe you went and you logged on and you saw your balance and you're thinking, wait a second, that was more money than I even borrowed. Why is my balance higher? I don't understand. I'm going to explain that to you. So when people first got their EIDL loans, when the first round, they offered what was called deferred payments. So you could not pay when you first got the loan because they were trying to help people out with cash flow, right? So that made sense. At first it was 12 months, then there's 24 months, and then they extended it all the way to 30 months where you didn't have to make any payments on a loan. That is 2.5 years. But the very important part is that the loan interest accrued during those 30 months where you weren't paying anything. So what happened is when you first got the money, interest started accruing right away. Yes, the interest rate was low, 3.75%. That's fantastic. You can't get a business loan that low, especially not now. But the point is that it is still interest. And when you don't pay a loan, any payments for 30 months, that interest is sitting there and just building. Once your payments start to kick in, the way that it's set up is to pay interest first. So it's going to pay off that accrued interest first. So I'm going to show you guys right now, we're going to hop into an example and I'm going to show you what this looks like and what happens and how long it actually takes to get below that original amount you even borrowed in the first place. And it's kind of shocking, to be honest. Okay, let's go ahead and get into it. Okay, so here's the EIDL amortization schedule, and this is an example. This is on the example tab, and I'm just gonna use this one to walk this through with you guys. In this case, there was an original amount of $75,000 EIDL loan. It was a 30-year loan, which all of them were when you first got them, which is 360 months. The interest rate was 3.75%. The interest started on the date that we got the loan, which was 6/1 of 2020, so June 1st, and then the payment started 30 months after that, okay, on December 1st, 2022. And then the EIDL payment amount is $400. So this was a calculated amount, but for a $75,000 loan, $400 would be paying it off in 30 years with give or take a few dollars here or there. So again, this is a simplified amortization schedule. I don't have it daily compounding, I just have it monthly compounding, which does change the numbers very slightly. Okay. What I have here and what I want to show you is this is a collapsed version. So this is each one of these lines represents a year. So I'm going to expand it out so you can see what's happening. And I'm actually going to make this a little bit bigger for you guys. So what's happening when we first got the loan on June 1st is that the balance on the loan was $75,000. And so the monthly interest was $227. So when you look at that, you're like, actually, for getting $75,000, it's not a lot of interest in the grand scheme of things because the interest rate is so low. However, what happens is that that amount adds to the total. And then the new interest is being calculated on that added balance. So you take balance plus interest, and that's the new amount. And then you keep doing that for 30 months. And at the end of that, we have just added, this is the end of that 30 months here, and the new balance on the loan is $82,000. So if I were to take the $82,000 minus the original $75,000, before I've made any payments, I just got myself $7,359 more in debt. So I now owe, and what I'm trying to pay off now is this $82,000. So I think that's one of the things that people didn't really think about when they took these EIDL loans and they weren't making payments. And it's a reality of the situation. So I wanted to make sure that you guys really understood that. I did do videos way back when, but I know not everybody saw them. So I think this is kind of shocking to people when they go and they pull their statement. Maybe they've been making payments, for, this is 2022, all of 2024, and then they're going to look at their balance sheets at the end of 2024 and say, oh my gosh, I still owe $78,000, $78,669. That's more than I originally borrowed. And I've been making payments for a year and a half or 2 years at this point. So if you've been making payments for 2 years, you would think you would have made a little bit more progress. So I think this is just what I wanted to show you guys about the effects of this compounding interest here. This is like the bad part about it, not like the good part about compounding interest, but this is where we see that, we can really dig ourselves into holes where we have to pay for extra long because we've accrued all this interest. I'm not saying this to make you feel depressed or anything like that, but I really want you to understand the effect of only paying the minimum payment of what the SBA is telling you to pay. And so in this case, I want to show you how long it will take before we're back down to what is due of $75,000. So you can see all of year 5, all through 2024 into 2025, and then into 2026, we are still above $75,000. So it does not change until we get to November of 2026, when payment started in December of 2022, almost 4 years of payments before we get down to below the original principal amount of the loan. So I just wanted to bring this up to you guys because I feel like this is going to be a confusing point for people, and they're going to be wondering why their debt, they're not making bigger progress on their debts. And so the main thing here is that if you want to make a bigger progress on your debt, you're going to have to change this number, this $400 payment number. You're going to have to make bigger payments. So if we change this number, let's say to $1,000, maybe 400 was actually pretty low and you were like, okay, that works for a while, but I can make better payments for that. If that's the case and you can make $1,000 payments, you're going to be done, completely paid for this loan by year 10, rather than taking 30 years to get this thing paid off. So I just wanted to bring this up to you guys so you understand the math behind your EIDL and why your balance has been increasing even though you've been making payments, because I know that this was really confusing for some of my clients when they were looking at it and they said, how could this happen? And when you really think about getting to year 6 and not really truly making any progress, that gets a little bit depressing for people. So I want you to know, so you have the power to make the changes you need to make for your organization. And if you have any questions, please put them in the comment section below. And then if you don't already have this amortization schedule, go ahead and grab it so that you can understand what changes you could make in order to get rid of your EIDL even faster. Well, thank you guys so much for being here. I'm here to support you in your business, and I truly want the best for you, and I want all the financial success for you. All right, talk to you guys soon. Bye.